Hello everybody. I mean, at 1:30, I think it's time to get underway. There's a plethora of attendees just logging in now, so that's great. Welcome to Primary Care Direct's latest webinar, the PCN and options for becoming a limited company. We have three speakers today. Neha Shah with Capstick Solicitors will get us underway, followed by Jenny Hurst at BHP Accountants, and Pooja Solanki, also at Capstick Solicitors, will conclude the presentation. We have scheduled 5 minutes 5 minutes per presentation or per presenter for questions at the conclusion of each presentation. The questions can be, if you can draw your attention to the Q&A facility, that's where questions can be recorded. We'll look to address as many of these as possible, but in an hour and a half, Neha, Jenny and Pooja are going to be giving you a lot of really handy information. I'll hand you, without further ado, straight to our first presenter, Neha, who will be discussing the corporate entity. Neha, over to you.
Hi everyone, I'm Neha, I'm a partner at Capsticks, and we're going to be looking at corporate entities. So on the next slide, you'll see the sort of things that I will be looking. Oh, a little bit about Capsticks there, and just who we are. We're a national healthcare firm. But on the next slide, we'll look at the types of things that I'll be covering today. So we'll be looking at the different corporate structures that a PCN company can take. We'll look at the changes that have been made to the NHS pension scheme. We'll look at whether this company can be a service provider if you wanted it to be. We'll look at things like liabilities and 2P as well. And at the end, we'll look at the type of documentation you would need to set this up. So that's just what we're looking at today. Now, we have received a number of inquiries, which is really why we're holding this webinar, because it seems to be a hot topic despite everything that's going on, obviously. And the reasons that we're getting for people wishing to, PCNs, practices wishing to consider setting up a corporate entity is initially really around employment. So practices, PCNs want to take advantage of the additional roles. Obviously, there is 100% reimbursement, and of course, there are more roles than there were initially. So when it was just sort of the clinical pharmacist and possibly the link worker, which again, maybe not even direct employment, more likely employment via a voluntary sector organisation, it didn't seem like there was a huge burden, particularly on the lead practice. But what we're hearing from a number of lead practices is actually there is this appetite to employ. However, and it's not just about the reimbursement, but there is actually a lot of additional burden on the practice themselves, and they're looking to move PCN employment away from their practice. And when you're looking at 10, 15, 20, potentially more employees, you can see how that can quite quickly ramp up. The other reasons we're sort of getting is, there may be federations in a particular PCN area, and they have a very good relationship with them, but for whatever reason, they haven't been able to make this link successful. And sometimes we hear that it's because there are too many other PCNs to consider. So it's a combination of things, but really in the main, we're receiving this because of employment reasons. And then there become secondary reasons. Maybe we do want it to be a service provider. Maybe we want to subcontract part of the desk to it. So we'll look at that as well. But just some things to consider when you are looking at your corporate model. The nominated payee. Now, in order to be the nominated payee, the rules haven't changed. You still need to hold a qualifying contract. So that's GMS, PMS, APMS, or NHS standard with the Schedule 2L. It's unlikely if you did set up a corporate entity that it would have this contract in place. And so you do need to be mindful that the nominated payee may still need to be there and have arrangements in place to transfer money across to the company. As I said, employment seems to be the big issue with setting these up. And one of the barriers to this has always been the pension scheme. However, we'll look at how that has changed and actually how effectively that hurdle seems to have disappeared, which is great news. Jenny will look at VAT in more detail, but if you are setting up a separate entity, there may be VAT issues, and it's just looking at how we can mitigate those to make this as beneficial and successful as possible. As with everything, there are additional costs and potentially additional compliance issues as well. So just to be mindful of those. If you want the company to be a service provider, does it need to be CQC registered? Think about employment insurance, indemnity policies, that sort of thing, and just additional compliance issues that you may need to undertake. As I said, can it be a deliverer of the services? And yes, it can, and we'll look at subcontracting in a moment as well. So on the next slide, we'll see the different corporate structures that you can have. I'm going to be concentrating on the last one there, the company limited by shares, and I'll explain why in a moment. But there are different corporate structures, of course there are. So company limited by guarantee. This is usually used as almost like a membership organization, and it's a structure where there aren't shareholders, they are members of this particular organization. The limiting factor for this type of structure is that it can't hold GMS and PMS, and not necessarily an issue because I don't think many PCNs envisage the company being able to do that. But the ramification of that is that it impacts on its ability to access the NHS pension scheme in full. And that's why this is not really as a popular structure. And you'll see that many federations have not taken this form as well. An LLP, which is a limited liability partnership, always sort of very, very popular, especially with general practitioners, and that's because it sort of has the best of both worlds. It's a hybrid between a company and a partnership, so it retains some of the familiar aspects of a partnership, but again, you don't see many of these, and for very similar reasons. Can't hold GMS and PMS, which again, as I said, may not be a big issue, but then it has the impact on being able to access the pension scheme fully. So I will concentrate on a company limited by shares. On the next slide, I've got a diagram as to what that looks like, but this is the one that provides the most flexibility. It can hold all the core contracts, and it can also give access to the pension scheme, which of course, if you're looking at employment, is a big factor. So on the next slide, we'll see what this looks like in diagram form. So in the middle there, we have the company itself. Now remember, a company is a separate legal entity. It's considered to be a legal person, which means that it can hold contracts in its own right, access the pension scheme, it can provide services in its own name, it can be an employer, it can contract with third parties. Now looking forward, you may want to enter into relationships with other parties for a variety of things, and this could potentially be a vehicle to do that. So sort of looking at future proofing as well. A two-tier structure, so not quite similar to partnerships, but directors sort of run the company on a day-to-day basis, and the practices own the company and they're the shareholders. You can have one PCN owning this company, you can have several PCNs. It depends on the relationship with your neighbouring PCNs, I guess, and what it is that you are looking to do. We've done a mixture of them. We've had 5 PCNs in a particular area who have historically worked together and operated almost as one, but for various reasons split off into 5 PCNs, and they are forming a company together. And we've had PCNs, just one PCN, so each practice doing the same thing. So at the bottom there, that's the shareholders, and they are the owners of the company. So that's what that structure looks like. And on the next slide, we'll sort of have a sort of idea as to what it is that you need to consider when you're looking at a company. So one of the aspects about a company, unlike your partnership, is that companies benefit from limited liability. What this means is that because it's considered to be a legal person in its own right, it ring fences the risk. So if some nuclear option things go very, very bad and you need to wind the company up for whatever reason, its assets are used to make good any debts and liabilities that it has. So that gives a level of comfort to practices, especially when you think you're not just contracting in terms of your partnership, you're contracting with lots of other practices as well. As I said, it contracts in its own name, so that if it's the employer, it will be the employing party. It can be sued and sue in its own name as well. As I said before, there are additional things to think about. So Costs, looking at the additional costs, the company itself would need to have insurance in place depending on what it would be doing. If it's a service provider, we need to think about registration for CQC. And as an entity in its own right with potentially money flowing through it, you may have additional accountancy and other professional fees as well. Companies are registered at Companies House, and there are a number of reporting and filing requirements as well. So on an annual basis, those do need to be considered and filed. Again, VAT is an issue. It's an issue throughout PCNs that I don't think has ever really it hasn't really got to grips with, but Jenny will look at this in more detail. But if you are looking to form a company for your PCN, it is really important not only to obtain legal advice, but also accountancy and financial advice as well, because it would be incomplete without having both of those. So on the next slide, we also get asked a lot about community interest companies. Can this vehicle be a community interest company? And yes, it can. A community interest company is a company limited by shares or by guarantee. So it's similar to what I just spoke about before. However, it sort of has a special wrapper around it and some special rules. So it has an asset lock, which means the assets that are within the company cannot just be distributed. They must be distributed to another community interest company or to the community that the company has been set up for in the first place. With healthcare companies, it's quite easy to see what the community is that it is serving. There is also a dividend and an interest cap. So if you're looking to withdraw money from that company, there is a dividend cap. So not all of it can be, and some of it must be reinvested within the company. And it must serve a community purpose. As I said, again, with healthcare companies, it's pretty easy to see what community it is you're serving and what the purpose of that could be. So a community interest company is a possible vehicle that you can choose if you look to go down this road. So on the next slide, what would it look like? So what do the shareholders and what do the exit provisions look like? So you've decided to do this, you've got an idea as to who the shareholders are going to be, who the practices are going to be. There are a number of ways of dealing with it. This is just one. So the usual one, it's almost like you would have with your federations. A partner from each practice holds the shares in the company, and they would be holding them on trust for the other partners in their practices. And you can have a similar arrangement if there are a number of PCNs as well. But remember, if you do have the trust arrangement, you do need to think about a declaration of trust, just to make sure that it's acknowledged as to who the share is being held on trust with. The shares can have different rights. We appreciate that there, a number of, even in your network agreements, a number of things are distributed on the basis of list size, and that can be accommodated for as well. What happens if the named partner retires? Well, we would put provisions in place whereby they can transfer to another partner without having to go through a series of detailed hurdles. So all of those can be accounted for, but that would be seen to be the usual structure, not the only structure, but the usual structure. On the next slide, this has almost been the game changer, I guess. In June 2020, the NHS pension scheme published a circular which looked at various PCN options and what they had found PCNs were set up as, and whether or not they could access the pension scheme. And one of these options was using a corporate vehicle, because I think NHS England and the BMA in early documentation had already envisaged that whilst PCNs might start in one form, they will not necessarily stay in that form, and they may look to use a corporate vehicle, especially as they get bigger. So a corporate structure whereby the staff employed by it are directly assisting the practices in the performance of GMS, PMS, APMS, and PCN work, or under the additional roles work, could access the pension scheme. Now, what the company needed to do was apply for this special dispensation, and it's a special application to the scheme area team, and the special dispensation or the direction status would be available until the 31st of March 2023. So this has really changed the way that PCNs can look at this vehicle, especially from an employment point of view, because it is eligible to access the NHS pension scheme. And I go back to why I said that a company limited by shares would be a safer option, because after March 2023, what the Pensions Agency are envisaging is that this will be set in legislation for the period going forward, and we don't know what that's going to say. But if you were to hedge your bet on any of those corporate structures, you would probably go with a company limited by shares. On the next slide. So what happens to staff that you have already employed? Well, they can be transferred across to the company using 2P. We've looked at this with our employment team, and they said, well, can you terminate their contracts and then reappoint them at the company? And we felt that that was with risk on the basis that it wasn't really a termination event, it was a transfer event. So their employment can be transferred across to the company. You just need to be mindful of the terms and conditions that they were offered, and also the terms and conditions of the company. But again, those should be pretty aligned depending on how you have been employing, and as it's a company with all of the effectively the same people, hopefully those are not too dissimilar. On the next slide. Can this company be a service provider? Yes, it can. In a number of ways. So if you wanted to subcontract part of the DES or the whole of the DES across to the company, you can do. A number of the ones that we have worked with have said that this is not necessarily their initial consideration, but it may be something that they'd look to do in the future. And we've had a couple say that whilst they wouldn't be looking for the majority of the services, maybe one or two, particularly the care homes bit of it, they would like to, just because of the way that they were delivering it. It wasn't really practice-based. Subcontracting under the DES or your GMS contracts or your PMS agreements does require commissioner consent, so do be mindful of that. It doesn't have to only be a subcontractor, it can also look for contracts in its own right. So if there are any being commissioned, I'm not sure that there are at the moment, but if there are any being commissioned, then it could seek to bid for that itself. Again, who is the service provider? So just need to be mindful as to whether or not CQC is required. As a subcontractor, it does benefit from the Crown indemnity, so the CNSGP does flow to subcontractors as well. On the next slide. Oh, and that's it, that's me done. So if you have any questions, I'll be happy to take them now, although I think we're having 5 minutes now and then possibly some time later on. Thank you, everyone.
Thanks, Neha. No, I think we can do the questions now if you're happy with that, and then we can have 5 minutes if necessary. Yeah, I've got a couple of questions already, and we have also, before I get to the questions for yourself, Neha, I've been asked if the slides will be shared. And the recording of the webinar will be available. Yes, they will, and yes, it will. The recording for the webinar will appear on the Primary Care Direct website as well. So, Neha, to yourself, the first question we had, one of our attendees has a federation in existence at the minute, and the members are also the same members of the PCN. So therefore, is it worth incorporating the PCN?
So it on the basis that it's arm's length, a federation is a good idea to especially to be the employment vehicle. It depends on the relationship, I guess, that the PCNs have with their federation, and a number of the things that we've heard from our clients who have taken this forward despite having a federation is possibly that it wasn't personal enough. They didn't have enough autonomy over the roles that were being picked, or the federation was looking at all of the PCNs, which rightly, of course, they would. And that was either delaying matters, or it meant that they didn't feel like they had enough control. And so they felt the federation had its role, but it wasn't necessarily this. And they felt that the company on the side was almost a mini federation, possibly sitting closer to the PCN.
That's great, thank you. I hope that was helpful. Thanks for your question, Bimal. And Grenville asked as well, now I think you addressed the community interest company as a company limited by shares to some extent. But I think, I'm not sure if there's anything to add to that from that point of view. The question is, what about community interest company as company limited by shares? I think Grenville asked this before you got onto that section. Actually.
Okay.
Is there anything to expand there?
I mean, I don't think I have anything more to add other than, I mean, a community interest company, as I said, it's just a wrapper. It can be a company limited by shares. It has all the same sort of features as a company limited by shares does, but with these added bits to it. So like the asset lock, the dividend cap, in exactly the same way as an ordinary company limited by shares, it can contract with third parties. And actually, we've heard a number of ICSs and things do prefer a community interest company on the basis that it clearly and has that social purpose, and is fairly transparent as well. Jenny, I don't know if you've got anything to add to that.
I was just going to add, from a as an accountant, from a financial viewpoint, my preference would normally be to go for to not go for a community interest company, well, certainly for a PCN limited company anyway, because I would always like to see an option to draw dividends out for the shareholders, and a KIC, a community interest company, would restrict that.
Thank you both. Thanks for hopping in, Jenny. Appreciate that. Thanks, Neha, as well. One really quick question. Are you able to share the link for the NHS pension dispensation scheme?
Yeah, that's absolutely fine. If I send that to you, Damien, is that okay with if you circulate it with everything else?
Yeah, I can distribute that. That's fine, no worries. And in terms of sort of a wider question, Neha, are you seeing this as a growing strategic direction of travel for PCNs? Sorry,
shall I answer that first? Is that okay? Yeah. I really am. I mean, especially before Christmas, we were getting weekly calls about this, and a lot of this has been prompted by two things. One is the pension scheme access. So, I mean, it was almost shut down before because there was no access to the pension scheme. But the other catalyst for this has been the change to the funding for the additional roles, and the appetite to employ and take advantage of the 100% reimbursement, which of course you would. So in that sense, I do also, if PCNs are going to become bigger, there's nothing gluing them all together. There's no legal entity that a PCN takes at this moment. So you are literally a collection of your practices. So as you start to do more things, you may find more comfort in a company, because it does give you that separation from your practice as well. So I do see it as the direction of travel.
Okay, and there's a question from Joyce. I'm not sure if this is related. It sounds like it might be, but what would your view be for super practices?
Super practices. Well, they're not a legal entity in that sense, and they are just a collection of their practices. But I find super practices feel that they are in a stronger position because they're bigger in size generally, and they don't have the VAT issues. They don't have they have a little bit more in terms of HR and management and being able to absorb the additional admin, etc. requirements. So super practices, we don't really hear much from about this, to be honest, and it may be because they feel that they're resilient enough to be able to absorb some of the additional headaches that we've been hearing lead practices have been having.
Okay, thanks, Neha. We'll roll a couple of questions into one. One's probably a quick yes, no. But you, someone believes that the company would need to be registered with Companies House for corporation tax, etc. And also an operational question. Did you say that the nominated payee practice was still required and would be the banker for the company? And if so, what operational challenges does this create?
So yes, I mean, unless the company has a contract, one of the ones I mentioned, it cannot be the nominated payee, so it cannot be the direct banker. I'm sure Jenny will look at this, or I'm hoping Jenny will look at this, but it would have to still come in and then be able to be transferred across to the company until such time as it could potentially be the nominated payee itself.
Just to confirm, yes, I will talk a little bit more about that later. Yeah.
Brilliant.
That's great, thank you. And yeah, and to confirm as well, Neha, it would generally need to be registered with Companies House. Is that right?
A company must be registered with Companies House.
Right. Okay. Fantastic. Still a couple of questions. If we're done, I'm going to aim to get through these, but if we don't, that's fine. We'll address them later. And our other experts may also address some of these as well. From Richard, any issues having service delivery and staff employment through a company limited by shares and partnerships continuing to hold GMS contracts?
No, so that's exactly what's envisaged. We're not envisaging incorporating the practices, so the GMS contracts remain with the practices. This is sort of almost sitting alongside the collection of practices, and the company would be a service delivery vehicle and would obviously, as I said, employ staff. That's the main purpose at the moment. Other than the additional costs and things that I suggested and VAT, which can probably be overcome, there aren't any additional issues that I envisage.
Okay, that's great. Thank you. And just a couple more. You're doing great. From Nigel, the view of NHS England, so many new limited companies which were PCNs. So, sorry, Nigel, I'm not reading this very smoothly, but plus all practice are, is anyone concerned regards the added bureaucracy?
I can answer the top bit, the first bit of it, I guess. If you look at the very early documentation that the BMA and the NHS England put out, they did actually envisage PCNs sort of evolving and potentially evolving to a corporate structure, especially as they got bigger. So it's in their early documentation, so I do wonder if they would have an issue with it. They certainly recognise that it is a possibility.
I think also, just to add to that, Neha, I think the fact that the NHS are making changes to the pension legislation to allow the setup of the limited companies and the staff to be pensioned means that that there's no particular issue with that.
Thanks, Jenny. Thank you for all the questions. Great. Amir's got a query. Will the introduction, as far as you're aware, will the introduction of of ICS have any effect on these developments?
I mean, the ICS is going to be working with a number of different providers and you know, other health organisations, and that's the idea. I think you're probably, in terms of for the particular practices yourselves, you've probably got a voice, a collective voice in the form of a company if you use that vehicle. Rather than being a collection of practices. So if you needed to contract with them, you could potentially use the company as a vehicle to do so, because it's a legal entity in its own right, rather than practice A, B, C, D, etc., and then trying to work out where all the liabilities sit. So it is potentially valuable in that aspect as well.
Okay, thank you. I think we'll close the final question, and then we'll move on to Jenny. But Suman's got a question and give a couple of examples. So how much information is allowed to be given out to shareholders when any of the shareholders ask? For example, if GP practice who is a shareholder of a federation asks for information about the operation and finance, etc., can they share that? Can that be given out?
I think they can give out as much information as they wish to. Certainly, yes. Yeah, they can.
Yeah. Okay. So, and the final part of someone's question was, can they refuse? So I guess it's a case of what the governance board says.
That's right. You can set. I mean, the default is, I think, that shareholders aren't really entitled to much information, but we know that a number of federations feel, for transparency reasons and that sort of thing, they do send out information more than they're potentially or generally required to give.
Okay, and Suman's experience is that they're PCNs not giving out information that's being asked for. Is that fair? What are they entitled to, I guess?
I think as a private company limited by shares, the members, in other words, the shareholders, are entitled to see the full accounts.
Okay. Well, I hope that's helpful for everything. Thank you also, Grenville, for your thoughts on the CIC. And yes, so thank you very much for the questions. It's good to be really engaged, and hopefully we'll be able to give you some additional information there. Jenny, if I can hand over to you for the second part, discussing financial considerations, is that okay?
Yeah, thank you. I'm wondering
Thanks
if that's
very much, Neha.
Okay, so hello everyone, I'm Jenny Hurst, healthcare partner at BHP Chartered Accountants. So BHP are a top 40 accountancy firm in the UK, 5 offices in the north, and we have a large healthcare department within the firm. So currently we're acting for about 95 GP practices, and also quite a number of GP federations as well. So agenda today, why should you become a limited company PCN? First of all, one of the issues, as Neha's already mentioned, is VAT problems. So we'll also have a look at that and what we can do to try and get round the VAT issues. Quick look at limited company tax, also NHS pension, which Neha has already really covered, but we'll touch on that. Other little bits and pieces to think about, and then finally, what are the downsides? Because unfortunately, with these things, there always are downsides. So why should we think about becoming a limited company PCN? Well, largely this is to solve a lot of the issues that really weren't considered by the NHS when the whole PCN DES thing came about. Which is it's a couple of years ago now since the detail was first issued. So the main issue, as I say, is this potential for VAT costs that are irrecoverable for the PCN. Also, potentially, there tends to be a perceived risk for the lead practice. This ought to be covered off in the network agreement, but where you've got an arrangement where there's a lead practice employing all the staff, that practice can feel a little bit vulnerable and worry about what would happen if the DES contract went away and they were left with potential redundancy costs for those staff. Where we have a flat practice model, where there's various practices employing different staff, there's potential there for different employment terms across different PCN staff. And of course, staff all talk together, and that can become an issue as well. And then final point on there is this risk of accidental partnership. It's probably a slim risk, I think, this for PCNs, but and this stems from the fact that at the moment PCNs aren't an entity in their own right. So a partnership is classed as individuals working together in the course of business with a view to profit. So if the PCN is viewed by HMRC to be a partnership, but not doing everything a partnership would normally do, then there is potential for penalties there. So preparing accounts for the partnership and submitting a partnership tax return. But I think probably low risk on that one. So if we just have a look at VAT, which is, as Neha said before, probably one of the biggest issues. So the problem with VAT is that if you're employing a member of staff and supplying that member of staff to the PCN, that has potential for VAT consequences. So if you were to hit the VAT registration threshold of 85,000, in other words, if you were charging as much as £85,000 in staff costs to other practices, then you would have to register for VAT and add another 20% onto the cost of that staff in VAT. And of course, because by and large GP practices aren't registered for VAT, the PCN would be unable to recover that VAT from HMRC. So it would become an additional cost to the PCN. So possible solutions to that First one is if we had joint contracts of employment for each member of staff working for the PCN, that would get around the VAT issue, but unfortunately any members of staff on joint contracts wouldn't be able to access the NHS pension scheme. That wasn't clear at the outset when the rules came out, but that's come to light subsequently. So that really puts that one out of the window for most staff. The next option is if you set up, have a setup whereby an individual practice is not supplying staff, but they're providing a healthcare service to other practices within the PCN, rather than just supplying the staff. So in practice, this is rarely reflective of the true situation. I know I've had conversations with practices where I raise the VAT issue and they say, well, okay, we're providing a service then, but actually, unless you have an agreement in place that sets out the terms of that service that you're providing, and actually that is truly what's happening in practice, then you're still you still have a potential for VAT issues if HMRC were to look at it. In addition to that, it's not possible, of course, to provide a healthcare service for your admin staff working for the PCN, so you're still at risk on that front. Just to mention as well, when I talked about the £85,000 VAT registration limit, we're not necessarily just thinking about recharges of staff there. All GP practices will have other income that is also potentially VATable. Tends to be private work in general, things like occupational health work, that is VATable. So in thinking about the 85,000 threshold, we need to think about recharges of staff, but also other sources of income that might come within that threshold as well. So final possible solution is the cost sharing group for VAT. So let's just have a look at that. So a cost sharing group, what we do to create a cost sharing group is form a limited company. As Neha mentioned, a limited company is a separate legal entity, and the way it would be set up is that the owners are the partners of the PCN practices. That limited company would then employ all the PCN staff, and the company would then charge the members for their share of that cost with at no profit. And because it's charged at no profit, then that allows the company to make those charges without adding VAT. So it would be VAT exempt. There are various qualifying conditions to make sure that you get that VAT exemption. The first one is that the cost sharing group, so the limited company, must supply services to all of its members. So to all the practices, in other words. Second one is all the members, so again, the practices must carry on a relevant activity. Healthcare is a relevant activity, so we get a tick in the box for that one. The third one is that any services that are supplied by the limited company have to be directly necessary for use by the practices in their healthcare activity. So things that can be included are admin, HR, payroll, providing the staff legal and financial services as well. So they can all be provided exempt from VAT. And then a final couple, no profit element to the company, I've mentioned that already. And then the final one is the setup or the arrangement must be unlikely to distort competition. What that basically means is that the company must supply its members only, and they only get the VAT exemption for that element. And in other words, it couldn't supply other practices that weren't the members or the owners, and get a VAT exemption for them. So other things to think about, and Neha's already mentioned that it is now possible to subcontract the PCN DES to the limited company, and there was a change with this that came in on the 1st of October 2020. So previously, yes, we were able to subcontract work to a limited company, but the change from 1st of October is that the subcontractor, in other words, the company, can then subcontract onwards. So with DES work, we often have a situation where it's actually the GPs in the practices that do a lot of the work, like, for instance, the extended hours. So since 1st of October, we can now have the work subcontracted to the company, but the company can still subcontract back to the GPs to do some elements of that work. So if the whole of the DES service was subcontracted to the limited company and the limited company were employing all the staff, then there would be no VAT issue anyway. So there would be no reason to then even think about the conditions for a cost sharing group. So it would make the whole thing a lot simpler. Nominated payee, still an issue, as Neha mentioned. That would still go to probably an existing practice or whoever the nominated payee currently is. But really those monies would go into the limited company as payment for operating the PCN DES. Ownership structure, sorry Damien, can we just go back a slide? Ownership structure would need to be considered. So I've mentioned already that it would be the partners in the practices that would own the shares in the company. So they would be the members. In terms of voting rights, tends to be 1 vote per practice. In terms of dividends, we tend to see it tends to be based on list size, so you'd be entitled to more dividends and more shares the higher the number of patients that you had. There'd also be a requirement for not just members, which are the owners, but also directors as well. So the directors are in charge of running the company, and you'd need to think about who they would be. So once we've got the company, it's also possible that you might want to include future contracts within the company, and that would need to be thought about and made possible at the outset when setting up the company. Final point, limited liability, which Neha has already mentioned. So limited company tax. So we're assuming here that the limited company is operating the DES. So the DES has been subcontracted, it's employing the staff, and there are some profits within the company. So the company is a separate legal entity and it's responsible for its own tax payments. And the company would pay corporation tax at 19% on any profits, which of course is a saving on what the partners of GP practices would pay. So they'd pay 40 or possibly 45% on profits. So once the tax has been paid, it's possible to pay some profit out to the PCN partners in terms of dividend. Now, when dividends are paid out, there is further tax to pay. Although all individuals are entitled to £2,000 of dividends per tax year, tax-free. Now, some partners might not have any other dividend income, so that would be a benefit to them, but some partners may already have dividends from other investments and already have used up that £2,000 tax-free allowance. So in general, on the balance of any dividend payment, you would be looking at 32.5% tax if you're a 40% taxpayer normally. If you're a 45% taxpayer, then you'd be looking at 38.1% tax. Bear in mind, though, this is after the company has already paid tax on its profits at 19%. So in general, if the company pays out all its profits to the GP partners, then there's unlikely to be a tax saving there. But one benefit is if you want to leave some of the profits in the company, and you probably will need to leave some profits in the company to enable the company to have some funds to operate, then there would be no further tax on top of the 19% company tax to pay on that money. So anything retained in the company is sheltered at that lower 19% tax rate. So NHS pension access, I'm not going to spend too long on this because I think certainly those first 3 points about the temporary access up until March 2023 has been covered by Neha already. But the way that this would work in practice is you would need to set up your company before you apply for this temporary access to the NHS pension scheme. So you'd set up your company, you would employ your staff, and you would start deducting pension from their salaries, but you'd put it to one side until you'd had this determination status for the NHS pension confirmed. So you'd be sitting on a pot of cash there, waiting for your confirmation before you could pay it across. So what are the downsides? There are always downsides, as I mentioned earlier. I mean, for me, that risk of the temporary NHS pension access is just feels a little bit uncomfortable. I think that the whole intention of the NHS is that these sort of companies will be able to provide the pension. So I think as long as the company is set up properly and you take the advice that you need, then there should be no risks with that pension access. But it does sit slightly uncomfortably with me at the moment. You need to set the company up, and there are running costs involved in that. So it's all additional costs. You need to have your accounts on public record at Companies House, although there would be limited information to be filed there. There's an annual confirmation statement to be submitted every year. Very small fee, £13 a year for that, but it's still an admin hassle. And as we mentioned, somebody I think asked earlier about corporation tax. So we mentioned companies need to pay tax at 19% on any profits. So you would need to register and file a corporation tax return as well. And if, of course, you don't meet the deadlines for filing this information, then there would be penalties as well. 2P rules on transfer of existing staff. I think Neha again has already mentioned this, but of course existing staff come across to the limited company on their existing terms, although any new staff that you take on, you would be able to incorporate standard terms into their contracts, and previous staff, you'd have to bring them into line over a period of time. CQC, if you do subcontract the whole of the PCN DES into the limited company, then I believe you have to be registered for CQC. And of course, there is a time lag for achieving that registration. And then final point on there is just thinking about how you treat profits within the limited company if there are partner changes. So the normal route to dish out profit to practices would be by dividends. But of course, within the practices, we tend to have frequent partner changes these days. So it's how do you deal with any profit in the company that has not been distributed to individual practices and therefore partners. And I think that probably depends on how much we're talking about, how much is left in the company, and does anybody care, how big are the figures. But if they do care, income only comes out when the dividends come out, and there might be some agreement within individual practices about how other profits are dealt with. But it is a difficult one to deal with. So in summary, I think most of the issues that we see within PCNs are largely caused by this lack of entity, particularly the VAT problems that we see, and bringing in a limited company just gets round a lot of that hassle. I know a lot of you, certainly some of my Sheffield practices, do use existing federations to employ staff. So they're getting a service, and if you see no issues with that, then that may be sufficient just to carry on in that manner. And then final point is, do take professional advice if you're considering doing anything down the limited company route. I would say that as an accountant, but both myself at BHP and Capsticks can help you with that. But others are available, of course. And that's it from me.
Thank you very much, Jenny. That's great, as always. And it was a slow burner with the questions, Jenny, but we've got a few to get through now. I'm just going to run one over from the previous question session as well. Can the director and shareholder be different people, Jenny? And also, who should be directors and company secretary? What are their roles and rights?
Right, okay. So the directors and the shareholders can be different people. And I suppose in some instances you may want them to be. I mean, in general, in PCNs, it tends to be the same people involved, but it depends whether you want the directors to be people who perhaps have other skills to bring to the table. So there'd be no issue with employing different people as directors if that's what you chose to do. What was the next question, Damien? Sorry.
The next question was who should be directors and company secretary, and what are their roles and rights?
Right, okay. So directors do have a responsibility to the company. There's a whole list on Companies House of what directors' responsibilities are, but it's basically to make sure the company is run properly. I'm just thinking I'm saying this in front of two lawyers, so I may well be pulled up if I'm not careful. Feel free to add any comments you wish to, but yeah, make sure it's properly run. Basically, the secretary. There's no requirement to have a secretary with small companies these days, but if you do have a company secretary, then their responsibilities are to make sure everything is properly filed and dealt with, the accounts and the various Companies House forms.
Okay, thank you. Question from Caroline, and Neha was mentioned as well as yourself, Jenny. Bit of a scenario question, I suppose. Where one of the practices is operated by a bigger organisation such as a trust, what are the considerations or complications when considering the limited company structure? So there are lots of APMS contracts now run by non-traditional partnerships, and does this complicate things, and does it affect that?
So they're operated by trust.
For example, a trust, yeah.
We are talking about the DES, aren't we? So then subcontracting the DES. I don't think that should have an effect.
No, I agree, and we're seeing many more sort of trusts and other organisations, almost as you say, not just in relation to APMS, but GMS and PMS as well. And at the moment, there is no. This will not prevent access to the NHS pension scheme under that special dispensation. So that it doesn't prescribe the structure of the company or who can be shareholders or who can be directors. So as I said, they're planning on putting after 2023 in legislation, and we don't know and can't say what the terms of that are going to be or how prescriptive that's going to be. But at the moment, if you were looking at that whole PCN grouping, including, for example, the trust, who operates the practice, having something to do with this company, then there shouldn't be any issues in accessing the pension scheme.
No additional VAT issues either, from no different to what we've discussed.
Thank you. Hope that was helpful. Jenny, were you able to roll back a little bit to and explain the CSG and no profit cause? Does this apply to all limited companies?
Well, it could do. Yes, it could do. If you have an arrangement with your members where you're supplying services that were on that list, then you could have a cost sharing group. Certainly, yes. But you have to be carrying out a relevant activity, one of which is healthcare. Yes. So long as you meet all those conditions that I mentioned, then yes, you could be a cost sharing group.
Okay, thank you. A really quick question. Bimal thought the tax-free dividend was £5,000. Is that correct, or has it gone up a bit?
A couple of years ago it was £5,000, but it is currently £2,000.
Okay. If you, I'm just sort of filtering through the questions. When you mentioned the dividend payments, Jenny, would these be paid to the individual practices rather than to an individual partner?
It would go to the individual practice, but it's then up to the practice to share it out between the partners, usually in profit sharing ratio at the time. Okay.
And another question, possibly a little bit more subjective, but revisiting dividend payments. The sort of suggestion is not sure that PCN should be taking dividends for Caribbean holidays. Don't they go back to the practices, as you've just mentioned, and not individuals, and should be paid back for patient care?
I think that's a practice decision. I mean, you know, what practices do with all income is a practice decision. Obviously, some of it will be needed for expenditure and for patient care, but I would expect to be some profit element there.
Okay. And similarly, along those lines, you mentioned profit. Is that the right word? And again, I suppose that's a subjective view, isn't it? But I guess certainly technically it's correct, isn't it?
It is, and I think there's a lot of discussion really among PCNs, and there's a lot of feeling that that the individual GPs should have no benefit from PCN monies. But I think we have to consider that a lot of income that previously went straight to practices is now being funneled through PCNs, and that is looking like that will increase over time. So, and unless we're taking a profit element from that, we will find individual GPs may well find that actually their income is reducing massively. So, you know, I don't know if that view is sustainable for individual partners.
Okay, thank you. Another question: do you have any insights as to the long-term vision for PCNs as real catalysts for securing collaborative and integrated place-based care and support in the communities, and with a focus on population health, working, collaborating with the VCSEs and the housing sector, etc.?
I'm just trying to find that question because it's quite a long question.
219.
I think really you could take this where you wanted it to go. It was set up to start initially grouping practices and working collaboratively, but it wasn't only with practices, it was so primary care and general practice could have a hold in what was seen potentially as being run by the secondary care, etc. And the focus on GPs meant that they wanted them to collaboratively work, not just with themselves, but with other providers in the community as well. So really your PCN, you could, I mean, subject to obviously any national government changes about PCNs, you could potentially take them where you wanted them to go and really play an important role in communities and moving care out of the secondary sector.
Thanks, Neha. Do you have any thoughts on that, Jenny? Because that kind of addresses another point that's been raised about your thoughts on the links between the limited company, if you like, the PCN and other provider stakeholders in terms of integrated working.
No, I think, yeah, I mean, I'd echo what Neha says, really. You know, you can take it where you want, really.
Yeah, okay. Thank you both. Apologies we haven't got through all of the questions. We've got through a huge amount of them, though, but we will come back to these subsequent to the webinar. However, it's 2:30. We've got 30 minutes left, so I'd like to introduce Pooja Solanki, also of Capstick Solicitors. After thanking both Neha and Jenny, thank you very much. And Pooja's going to discuss partnership deeds. Over to you, Pooja.
Thank you, Damien. Good afternoon, everyone. As Damien mentioned, I'm Pooja. I work at Capstick Solicitors in the primary care team, and my main area of expertise is in drafting GP partnership deeds and declarations of trust. So we've so far really been looking at primary care on a national level, and I think it's very clear that whilst working collaboratively, so whether that's as a PCN or as a federation, is really the direction of travel for primary care in general. We have to bear in mind, and this has been mentioned already, that a PCN is not a legal entity. And so stability within that PCN or the PCN company is really down to each individual practice. And that individual practice making sure that their house is in order, and that they've really got the proper documentation in place to govern their business and their property as well. So this will then place not only the practice in a good legal and financial position, but also in the wider context of the PCN. So we drafted a number of PCN network agreements back in 2019, and I saw probably on average around 4 to 5 GP practices per PCN. Obviously that's very much a guesstimate, and those GP practices will form the core members. So, oh, can I go back one slide? Sorry, Damien. So of those GP practices, the majority will operate as a general partnership under the Partnership Act 1890. Jenny's already mentioned very briefly the definition of the general partnership, and I think it's always really good to go back to basics when explaining the legal basis upon which GP practices operate. So as Jenny said, the partnership is a relation which subsists between persons carrying on a business in common with a view of profit. I would add that that is the definition from the 1890 Act. It's never been updated or amended or changed since then. So that definition still stands for GP practices operating as at today's date. On the next slide. So I'm just going to look at the importance of partnership deeds. I think there's 3 main reasons why you need a written partnership deed in place. I think the first reason is fairly obvious. It will regularise your partnership by providing written evidence of the agreement of the partners. So it's really acting as the partner's rule book, I like to call it, as to how they want to operate their business. And that written rule book will provide certainty to all of the partners, as well as clarifying not only the partners' rights and obligations, but also as to how they want to run their business. So it will range from provisions relating to what assets the partnership holds, how decisions are taken, what leave provisions can be taken, and also what would happen, for example, if a partner were to leave or to die. The second bullet point is a really important one. And the existence of a written partnership deed will mean that you avoid being a partnership at will. I'm sure you have all heard that terminology before. And what a partnership at will is a partnership that is governed by the Partnership Act 1890 in the absence of anything in writing. As I said before, the 1890 Act has not been updated since then. So that Act does not cater to GP partnerships. If you do not have a written deed in place, therefore, you will be governed by default under the terms of that act. And in the next slide, I'll go on a little bit more about the characteristics of a partnership at will. Sorry, can I just jump back, Damien? Just the last bullet point. Last reason of having a deed in place, you'll avoid some disputes. So I'm obviously not saying that you'll never ever have a dispute if you have a written deed in place. But the point being that your partnership deed will have certain mediation and arbitration provisions which have to be followed in the event of a dispute prior to taking any matter to court. I've mentioned a really important piece of case law there, Chima and Jones. It's the most recent piece of case law in partnerships in the country. And the reason why it's so important in this particular forum is that Chima and Jones were GPs, and they were a partnership of two holding a GMS contract. They had a partnership deed in place, and as with all partnerships of two partners, all decisions were unanimous. On the 1st of July, Chima and Jones admitted 3 new partners. Those 3 new partners did not sign up to any new partnership deed with Chima and Jones. Chima and Jones then had a massive falling out to the point where Jones sought an injunction against Chima to stop him entering the practice and seeing patients or staff. Jones and the 3 other partners then served a notice of dissolution of the partnership on Chima. Chima argued that this was not allowed on the basis that under the terms of the partnership deed, a notice of dissolution had to have unanimous agreement. The case went all the way to the courts, and the courts actually held that Jones and the other 3 partners were correct in serving their notice of dissolution. And this is because on the date that those new partners joined, they didn't sign up to the partnership deed between Chima and Jones, and then the whole partnership automatically became a partnership at will. So on the next slide, the very first bullet point is probably the most important characteristic of a partnership at will, that is also the most worrying for any GP practice, in that any partner can give notice at any time to dissolve the partnership. It sounds quite extreme, but I've seen it happen personally to a client, which resulted in a partnership dispute, which then resulted in probably about £100,000 of legal fees. And it's exactly what happened in Chima and Jones. So that really shows you why you need to have that written partnership deed in place to stop any partner just giving notice to dissolve. I've listed out a few other characteristics of a partnership at will. So I'll just go through some of them. Death and bankruptcy, they technically trigger dissolution. So under terms of a partnership deed, if a partner retires or dies or is expelled, the terms of the partnership deed will still continue to be binding between the continuing partners. However, under a partnership at will, that's not the case. Those events would technically trigger dissolution. Partnership at will, you can't expel a partner, which can prove obviously to be quite troubling if you've got a disaffected partner in the partnership and you want to get rid of them. Profits and losses, they're shared equally. So the 1890 Act obviously will not account for differing sessional commitments between partners. There's no leave entitlements, which seems fairly obvious. Back in 1890, I suspect maternity leave and paternity leave weren't really something that was thought about. There's no power to suspend, no probationary periods for new partners. All decisions except admitting a new partner and changing the nature of the business are majority. There's no dispute resolution procedure. So I said before, your partnership deed will have mediation and arbitration provisions in it. Obviously, that would not be accounted for in the 1890 Act. There's no exit arrangements. Again, like I said before, death or retirement would cause a technical dissolution of your partnership. And then finally, there are no restrictive covenants which bind an exiting partner. So on the next slide, I've just gone through, just bullet pointed some of the effects of dissolution on a GP practice. So the first thing is that your business would have to be wound up. That's called a technical dissolution. And under the terms of a technical dissolution, all of the partnership assets would have to be sold. your NHS contract, and this is whether it's GMS or PMS, it will automatically terminate on the date of dissolution. NHS England would most likely take that patient list back and disperse it as they see fit, most likely on an APMS basis or across other practices. Premises will be a really big issue, or if you were to dissolve. GP practices will either own the freehold of their property or they will lease from a third party. In either situation, that GP practice is entitled to notional rent or rent reimbursement, and that's by virtue of their NHS contract. If your NHS contract terminates, so will your right to notional rent or rent reimbursement. And therefore, you could potentially be left with a mortgage liability or lease liability for rent service charge, which you may not be able to fund. And then finally, redundancy of staff. So if your GP practice dissolves, you no longer have a business, therefore you no longer need any staff. The redundancy costs and payments will be the responsibility of the partners. So the next slide. Partnership changes. I'm asked quite a lot by practices as to when they really should be looking at their partnership deed and when they should be updating it. I always think, as a general rule of thumb, read your partnership deed on a yearly basis. Think of it in the same way as you think of your partnership accounts. Even if it does not then necessitate an update or a change, you've just then reminded yourself as to the terms and as to whether anything needs amending or updating. In terms of actual physical partner changes, retirement of a partner, that does not necessitate an update to your partnership deed. The reason being is that your deed should include retirement provisions within it and the ability for a partner to retire or be expelled, and for the deed to then continue between the remaining partners without needing a change. So the legal trigger that you really need to be aware of is when a new partner joins. This takes you back again to Cheever and Jones, which is a really good example. You must update your partnership deed prior to a new partner joining. Reason being is if they join on the date that they join, if they haven't been included in the partnership deed, you will automatically revert to being a partnership at will. And as you can see, I've mentioned Cheever and Jones there as well. Just to bring in premises considerations there, the new partner will have an obligation, or may have an obligation, to either purchase a share of the freehold if the partnership occupies under a freehold, or they would need to be bound into the terms of a lease. Those provisions must also be included in the new deed to ensure that new partner has been bound in. The next slide. So I've seen quite recently an increase in partners coming in and not necessarily being equity partners. And there are a few subsets of partner status, which I've mentioned here, and that's fixed share partners and salaried partners. Salaried partners might be a slight red herring. I'll get onto that in a minute. But a fixed share partner has become quite popular recently. So a fixed share partner is still self-employed. You would still be a partner under the terms of the deed. But instead of receiving a percentage share of the profits, you would receive a fixed share of the profits. And you would not be liable for losses of the partnership over and above that fixed share. So a fixed share partner would not contribute to the capital or the property if the partners obviously own the freehold. And their consent would not be required, for example, to approve the accounts. Their decision making might be limited. And the kinds of professionals that you would see, or I've seen as a fixed share partner, are, for example, the practice manager or a practice nurse. Salaried partner, like I said, this is a slight red herring in that a salaried partner is still an employee. So they would not be a partner under the terms of the deed. They would still retain their employment contract. But the difference between a salaried partner and maybe the other employees is that a salaried partner may have rights over and above an employee. So for example, they might have voting rights on day-to-day matters. They may be able to sign checks under the partnership bank accounts up to a certain amount. And I've seen practice managers be classified as salaried partners. Next slide, please. So I've just mentioned here the new to partnership payment scheme. You may be aware this came into place last July, and it is applicable for new clinical partners from the 1st of April 2020. And it was really, I guess, a monetary incentive from NHS England in order to encourage GPs and other healthcare professionals into GP partnerships. There are certain criteria that have to be met in order to qualify for the payments under the scheme. You have to be new to partnership and not previously been a partner in England. You have to commit to at least 5 years of equity share partnership. I should have underlined equity there, but these monies would not be available to a fixed share partner. You have to deliver a minimum of 2 clinical sessions per week. That new partner must sign a partnership deed. I haven't heard yet, but I suspect NHS England would want to see evidence of a signed partnership deed prior to signing off on the monies. And the monies that would come in are a £3,000 training fund, a £20,000 pro rata sum, and a 20% contribution to tax and NI. So in terms of your partnership deed, you need to include very specific provisions relating to the scheme, not only in relation to whether or not the new partner meets the criteria in order to qualify for the monies, but also in the event that that new partner does not stay the period of 5 years that they are required to stay, because there will most likely be a clawback of those monies from NHS England. That clawback will probably take place from the practice. Therefore, there needs to be a flow of money from the new partner back to the practice up to NHS England, and that all needs to be accounted for quite specifically within your partnership deed. And on the next slide, I've just put in some information that you may wish to include in your partnership deed relating to PCNs and the PCN company. So your primary care network agreement should already have specific provisions in it relating to the PCN undertaking and establishing its own set of accounts. Once those accounts are done, there is then a flow down of monies, of surplus or deficit monies, as the case might be, down to each individual practice member. So within your partnership deed, you need to include within the partnership assets the general treatment of that surplus or deficit monies from the PCN and how that is dealt with within the partnership accounts. You then need to deal with, and obviously this would also be very much an accounting point of view as well, the flow down of that money to each partner's current account balance. And this is particularly important when you're calculating payments that are due to an outgoing partner on retirement or death in relation to what monies are owed to them and what aren't. And then the final bullet point, this has been mentioned by both Neha and Jenny in the talk. You need to be, if you do incorporate into the PCN company, you need to amend your partnership deed to include the share that is held by the nominee partner in the PCN, which would then be classified as an asset of the partnership on the basis that that nominee partner will hold the share on trust on behalf of the other partners in the partnership, and that's called share assets. And then the final slide, I've just put together really a roundup, I guess you could call it a crib sheet, of the questions that you might want to ask yourself in relation to your practice. So the first is, do you have a partnership deed in place? And if so, when was the last time you looked at it? And is it valid? Has a new partner joined and not signed up to it? If so, the likelihood is that that partnership deed is no longer valid. If it's not valid, highlighting again the risk to you is that any partner can dissolve the partnership at any time without notice. And then finally, given the specific provisions that you want to be including in your deed at the moment, not just in relation to the new to partnership payment scheme, but also think about whether you've adequately covered PCNs, the PCN company, and any monies coming in via that vehicle. Thank you. Any questions?
Thanks very much, Pooja. That was great. And a new one on me. I've not gone into that much depth on property. So that's fantastic. Thank you. We've got one question. Does the deed need to change when an existing partner takes on managing partner role from a partner who's going to retire?
If it's an existing partner, then and they're already all on the partnership deed, no, you don't need to amend the deed. My suggestion would be that you have a partnership meeting. You minute in the meeting what responsibilities that partner is going to be taking on, how their role is going to change. Everyone sign off on it and append it to the partnership deed. From a legal point of view, your deed will remain the same.
Great, thank you. Hope that helps. And under the new partnership money, is this allocated to the new partner only or used at will? Excuse me, I've read that wrong. Will it be allocated to the new partner or to the practice?
The money will come to the practice, but it is specifically for the new partner. The practice must distribute it to the new partner, which is why there have to be provisions in your partnership deed for the new partner giving that money back to the practice in case that new partner leaves prior to completing the 5-year required term.
Okay, thank you. An understandable concern. Who's going to do all this?
Okay.
I've put you on the spot there a bit, Pooja. To expand a little bit on the question, apologies. Sort of, would that be the PCN clinical directors as they're the accountable officer? I think the suggestion is there's a lot of people, well, people might not have the time to do the nuts and bolts as such.
Do you mean sorry, I don't understand the question, Damien. Do you mean the partnership deed?
Yeah, I think so. Let me read through it. It's from Nigel. It says that he's got a slight concern. He's not sure who's on the call, but who is going to do all of this? Will that be the PCN clinical directors? And they are the accountable officer. And I think that he thinks these clinical director colleagues will struggle with some of the legal detail and might see it as a bit of a turn off.
Right. So in terms of the partnership deed, the partnership deed is each individual practice's responsibility. So the partners collectively within that practice should be making sure that they have the deed in place and that their property is governed as well. They wouldn't be, for example, be able to palm that off onto the CD or an accountable officer. Does that answer the question?
Hopefully. I guess everybody's circumstances are a little bit different, aren't they? So, but yeah, it makes sense, definitely. If anybody has any more questions around the partnership deeds, do feel free. I mean, is everybody happy just to roll back a little bit to some of the finance questions just while we're here? Is that okay? And then if anything pops up, Pooja, I'll come across, or indeed you may be able to answer some of these. So that's fine. In terms of one of the questions was, would partners, Nehar or Jenny, would partners actually be subject to additional taxation if a limited company was taxed on profit, then individuals on dividends?
Yes, there was. Yes. Assuming that individual partners have dividends in excess of £2,000, so they still get the £2,000 tax-free.
Yeah. Okay. Thank you. Let me just see again. I'm just filtering the questions. And we have one question. What changes do you think, this is for Pooja, excuse me, what changes do you think should be made to sickness, illness clauses in the partnership deeds in relation to long COVID? This person knows of GPs who are being expelled from practice under these clauses because they're unfortunately suffering from long COVID.
Effects of COVID, it's a really tricky one. Expulsion due to illness is a really tricky issue when dealing with it in a partnership deed. You should always take legal advice. There's the risk of discrimination. I don't think specific changes can be made to the deed just to relate to COVID. It would be, and obviously anyone else correct me if I'm wrong, I think it would be viewed as any other long-term illness. And in order to be equitable and fair, the provisions or whatever provisions you have in your deed relating to expulsion due to illness would have to be applied in the same way as if it were applied, for example, if someone was suffering from cancer or something like that.
Okay, thank you. Another question, a little bit more specific as well. Where does the expression incorporation fit into this, please, Pooja?
Incorporation pure, sorry, I'm jumping in there. Incorporation purely means setting up limited company. So putting the PCN or whatever you choose to put into the limited company, it's just a different word for the same thing.
Great, thought so. Very helpful. Thank you, Jenny. Okay, let's see. I'm just going to roll back again to one of the finance questions. If a super practice is not a limited company post 2023, can they still access NHS pensions? So rolling back. So is that you, Neha?
Yeah, that's me. Yeah, yes, they can. The special dispensation, which is available until 2023, is only in relation to setting up a limited company. So as a super practice, you hold the GMS contract or the PMS agreement and are therefore automatically eligible to access the pension scheme as an employing authority, and there's no time limit on that. That's going to go on for as long as it can. This is specifically in relation to companies, the special dispensation is, because there was nothing governing it whatsoever in any of the legislation. And as Jenny said, NHS England, we felt there needed to be something because there was a lot of movement in this direction. So it's just something that's out of legislation and put together by the Pensions Agency in order to deal with it. So it doesn't impact on any other access to the pension scheme or anyone else's access to the pension scheme.
Okay, great, thank you. Rolling back a little bit further as well, presumably a supporting and holding federation and PCNs can create an integrated structure and create a VAT group. Just go back to the CSG question, Jenny.
Yeah, so anybody who, you can have a VAT group, a cost sharing VAT group with services between a limited company and its owners. So in any situation where you've got that, then you can potentially set up a VAT group.
Yeah, I've certainly had this with existing federation clients who saw the direction of travel in terms of working more closely with their PCNs and aligning themselves with their PCNs and wanting to deliver services. But obviously because of the VAT issues, they felt they may not be able to, but then looked to become a cost sharing group in order to be able to do so. So it is certainly possible.
Great, thank you. There's a couple more points, more talking points really, and it's around the support that practices PCNs might need. Talking about addressing Nigel's point about who's going to do all of this, and do we expect clinical directors, GPs, and practice managers to get their head around all of the technicalities, if you like. And a small word from primary care director, from myself, I suppose. And Jenny and Neha addressed this. You do need to access the professionals, certainly around some of the more important stuff, certainly around the legal stuff. And my understanding also is, Jenny and Neha and Pooja might be able to expand again, there is some funding to commission this support, is my understanding. One of Primary Care Direct's current activities is board development and that type of thing. So there is, get people in if you need to, is a recommendation I would make, if you can. And again, there are other providers available. But I wonder if Jenny, Neha or Pooja, do they have any more thoughts on that?
Not specifically on the funding, but I think in general, I mean, I wouldn't necessarily expect that the CD would get involved in this sort of financial detail. It depends on your PCN, doesn't it? But often these things end up with the practice manager and perhaps somebody who's particularly interested in finance. So there's not necessarily an obvious choice, but I sort of hear what you're saying. I think the key is that with the proper professional support, it could be made simpler and less time consuming for whoever ends up picking this up.
I agree. I echo what Jenny said. I agree. It can be time consuming, but it may be worthwhile in the longer run.
Certainly accessing webinars such as this and other available sources of information helpful. And I guess it's about having those first conversations as well, and exploring the requirements and what you need to do and how people can help if necessary. We've probably got about 30 seconds left, so hopefully that's been really useful for everybody. I'd like to thank our panelists, Pooja, Neha and Jenny. Again, the slides will be shared with all attendees. Thank you for joining us. And the recording will appear on the Primary Care Direct's website as well in due course. And you will have the contact details for each of our panelists. Pooja, I'm just going to double check. Did you include your contact details on the final slide? No.
I'll send it through.
It's okay. We'll make sure they're added before we distribute the slides. So everybody's got access to everybody we need to speak to. Yes, okay, and thank you very much. Any final points from our panelists?
Putting us on the spot now, Damien.
Right, it's okay. Time's up, it's okay, 3 o'clock. No, that's great, thank you. And hopefully some people will be in touch with you with their more specific concerns or their more specific requirements.
Yeah, that's absolutely fine. If they have anything specific, we're happy to take questions as well. That's not a problem.
That's great. So, thank you very much, everybody, and hopefully see you again soon.
Thank you.
Thank you. Bye.
Bye.
Bye.